If you're watching this, the markets are probably jumpy or under pressure and you're getting a little nervous. Maybe even wondering, should I exit the markets? Should I sell? Hi, I'm Chris Heisey, Chief Investment Officer for Merrill and Bank of America Private Bank, and I want to help put moments like this into perspective for you. First, it's important to remember that volatility is a normal and an expected part of long-term investing. Economic data, earnings updates, policy changes, and global events all feed into the day-to-day moves you see. They're how markets adjust when new information comes in. Sometimes those moves can be dramatic, but markets have weathered volatility many times in the past, and they've continued to advance over time. Knowing that doesn't necessarily help, of course, when you're watching the value of your portfolio decline. But pulling out of the market during volatility just means you're likely to miss out on potential gains if it eventually recovers. Trying to time the markets involves at least 4 separate decisions in our view, not just one. When to exit, what to exit, and when to enter to get back in, and where. The Chief Investment Office has put together what we call the Core 10. Now, these are principles that can help investors manage their portfolios and navigate the markets. One of them in particular can really be helpful during periods of volatility. Follow the trend lines, not the headlines. Headlines are loud and immediate. Trend lines like long-term earnings growth, innovation, employment, and broad economic strength are quieter, steadier, and ultimately far more important for your financial life. Pay attention to them. Another timeless investing principle is the best days often follow the worst days. This is why reacting emotionally or stepping out of the market during a rough stretch could mean missing a recovery that may follow. And remember, to try to view the full picture. Zoom out, not zoom in. What you're seeing during volatile periods isn't always everything going down. Sometimes it's rotation. Leadership shifting between sectors, styles, or regions. Rotation can feel bumpy even when the long-term view is still constructive. So what can you do when the markets get bumpy? First, stay grounded. Volatility feels intense at the moment, but it has rarely changed the long-term trajectory of markets or your goals. Second, stay diversified. A mix of asset classes and sectors and geographies can help reduce the impact of any one swing. And third, stay disciplined. A well-built plan is designed to help minimize losses and carry you through periods of uncertainty. And here's something especially important. Seek guidance. If you work with a financial advisor, this is the right time to talk to them. An advisor can help you step back, zoom out from the noise, revisit goals, and make sure your strategy still aligns with your life and your risk tolerance. The bottom line here, volatility comes and goes. That's normal. But staying focused on the fundamentals, staying diversified, and staying committed to your plan can help you stay on track, no matter what the markets are doing.